Today, mortgage stress grinds higher in February. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I want to walk you through our latest research from our surveys. And this takes the data to the end of February. So this is before the events in Europe really took off and the sanctions pushed oil prices even higher. And yet even then, mortgage stress and financial stress more generally was on the rise. So we'll look at the details and also perhaps talk about some of the underlying drivers. Now, just by way of introduction, the DFA research uses our rolling household surveys. We have 52,000 households over the year, and we ask quite detailed questions with regard to their finances and their expectations. And the data is very current insofar that we get information back each week. Now, what we can then do is to take that information, analyse it, and we slice it and dice it all sorts of different ways. And we can look at it by location, by segment, and by property status. And that also allows us then to take the data and begin to think about some summary outcomes in terms of what the economy might be looking like in 2 to 3 years ahead. And as well as that, we take the mortgage stress data, the price trajectory data, the buying and selling intentions, the migration statistics, the economic data, bang it through the core market model, and that allows us then to form an opinion down at a postcode level as to what's going on. So this model has the benefit of being very granular at one level, very current, and also very objective insofar that I've got no axe to grind at all. I'm just trying to relay what I see. Unfortunately, some of the other data sources that come out actually are a bit skewed in my view because of the specific agenda that they want to pursue. Now, just before I start, let me just also remind you that you can have a conversation about a specific suburb with me in our one-to-one service. And that's a confidential conversation where, whilst I don't give you any financial advice, I can talk about what's going on in that particular area and look at some of the underlying trends. I can look at stress, home price data, and also the trends ahead based on our modelling. And you can book up to an hour's call, either by Zoom or phone. And there is a cost attached to it simply because there's a lot of research to be done to be able to put that together. And if you are interested, you can contact me via the blog. The links are below. And spaces are limited each week, but at the moment I'm booking 3 to 5 weeks ahead. There is a lot of interest out there and a lot of concerns about what's going on with regard to property and what might be ahead. So this is a good time to have that conversation. So reach for me if you'd like to have a conversation on a one-to-one basis. Anyway, let's now get back to mortgage stress, and we start with a summary chart which shows you that in February 41.6% of households are actually in mortgage stress. Now that's higher than the previous month, not dramatically higher, but it is somewhat higher. And it's also worth noting that the RBA continues to show that the household debt to income ratio is on the rise. So what we're seeing is more debt with more people getting into difficulty. So let's look then in detail at the information for February. And the first point to note is that there are 1.52 million households in mortgage stress, which translates to 41.59%. And if we look across the states, we can see that Tasmania still has the highest proportion of households in stress at 52%. That really is a function of the fact that house prices in Tasmania have gone really high relative to incomes, to the point where in fact it is quite difficult for many people to afford to buy in Tasmania at the moment. And some of that purchase activity is driven by interstate buyers, including property investors. Now, if we then look down the list, you can see that in the Northern Territories, just over half of households are in difficulty. Whereas if you look in Victoria, it's about 45%. In New South Wales, 38%. The ACT, 38%. South Australia is a little higher at 41%. And Victoria is higher than WA, which is sitting at 40.19%, giving an average of 41.59. Now we can also look at rental stress, and rental stress is highest in New South Wales, where 52% of renters have cash flow issues. It's 50.94% in the ACT, and then it's slightly less stressed in Tasmania at 42%, in Victoria at 40%, but I'd also highlight the fact that the ACT is quite high at more than 50%, WA is at 32%, and the average is 41.34%. And while we're here, we'll just look at the investor stress. So these are property investors, and we measure again in cash flow terms, but also take account of whether they're trying to sell their properties. And the highest state is the ACT, where 38.6% of investors are stressed. It drops down then to 31% in New South Wales. Compare that with 23% in Victoria, 24% in Queensland, 21% in Tasmania, and 21% in Western Australia. South Australia has 17.9%. And overall, 24.99%, or pretty much a quarter of property investors, are stressed. And finally, we have the aggregated financial stress metrics, which is a weighted average of mortgage stress, rental stress, and investor stress. And there we find that the ACT has the prize for the highest amount of financial stress per household. And the New South Wales situation is slightly better at 45%. Tasmania is at 41%. Victoria is at 40%. Queensland's at 39%. Western Australia is at 36%. And the other states there are a little lower, giving a total of 40.49% in overall financial stress. And I want to underscore again that financial stress is an aggregate of mortgage stress, rental stress, and investor stress, but it gives us an overall feel in the particular state. Now, these figures have been rising consistently, and they are now roughly 10% higher than they were pre-COVID. And we'll explain in a little while why that is the case. Now, another way to look at the information is by our household segment. Now, these segments are very important to understand because there are considerably different things going on for different types of households, or different cohorts, as I call them. For example, young growing families, which include a lot of first-time buyers, show that 74% of them are in mortgage stress, 47% of them are in rental stress. They have a lower measure of investor stress because not many first-time buyers and young growing families own investment properties, but overall financial stress is 59.75%. That's the highest in the series. If we then go and look at the battling urban and disadvantaged fringe segments, they are large segments that live on the outskirts of our cities and towns. And there, 64% of those households are in mortgage stress, and more than 40% are in rental stress. Again, their investment footprint is quite small, so the investor stress is quite limited, but overall financial stress is relatively strong. And then if we look at Middle Australia, the mature stable families and the suburban mainstream, we can see there that the mortgage stress levels at 34 to 35% are quite a lot lower. The rental stress is a little higher than you might want to see, more than 40%. The investor stress is a little higher, and overall financial stress is sitting well in the middle of the pack. If we then look at the multicultural establishment group, this is the first generation migrants to Australia. We find that mortgage stress is sitting at 36%. Rental stress is at 56%. That's actually one of the highest measures across the cohorts. Investor stress is at 34%, and overall financial stress is at 49%. And finally, we should just make note of the wealthy group, the exclusive professionals, where in fact their mortgage stress is 31%, but their investor stress is at 44%, and overall the financial stress is 44%. And also the younger affluents, this is a separate segment, where we see 49% of young affluent investors in stress. And it's worth noting that rental stress is very high, although mortgage stress itself is quite low. And I will also highlight that our older group, which is comprising the stress senior group and the wealthy senior group, also registers a considerable amount of stress. Interestingly, we find that amongst wealthy seniors, 43% in rental stress is quite a high number. And that is because they may be wealthy, but if they don't have a property behind them, then they tend to have significant cash flow issues relative to those who have a mortgage. By this time, of course, many have paid off their mortgage, but still 14% are still in mortgage stress, despite the fact they're moving into retirement. Amongst the stressed senior group, you can see that again, rental stress is a problem. So in summary, you can see that there are considerable differences across the different segments, and the characteristics of those segments are quite different amongst the 4 dimensions of stress that we look at. Now, what I want to do next is to go into more detail and look at the top postcodes in terms of stress. And I've sorted them by the number of households in stress. And we're going to start with mortgage stress. So the postcode with the highest number of households estimated to be in mortgage stress is postcode 2560, which includes places like Campbelltown. And there more than 10,700 households are in mortgage stress, or 88% of those borrowing. Another New South Wales postcode, 2170, that's the area around Liverpool, is second on the list with 10,574, or 71% in mortgage stress. And then we go to Victorian postcode 3805, Narre Warren. That includes Fountain Gate and Narre Warren South. And there, 86.5% of households are in stress, which is 10,400 households. Now, those first 3 are all what I would call high growth suburbs on the outskirts of town, where there's a lot of development, a lot of subdivision, and a lot of new building, home and land packages and those things all still available. And a lot of the people who've bought there bought quite recently. The next on the list is Toowoomba, 4350. That's up in Queensland. And that again is a high growth area with a lot of construction underway. 10,100 households in mortgage stress, or 65%. And then we come back to Victoria at 3806, Berwick and Harkaway, and there about 8,700 are in mortgage stress. And then we go to Craigieburn and Mickleham, Roxburgh Park in Victoria, 3064. Those 2 again are high growth areas on the outskirts of Melbourne. And then we go to Ballarat, regional area of course, where Ballarat has 7,000 in mortgage stress, and that's postcode 3350. Then we come back to New South Wales, 2567, including Currans Hill and Harrington Park and Mount Annan, where 6,900 are in stress, or 81%. And then we go to more high development areas like Pakenham in Victoria, 3810, with 6,800 households, or 70%. And then we go across to WA, including Clarkson and Quinns Rock, where 6,700 households, or 76%, are in stress. Then we come back to Victoria, to Sydenham and Hillside, again another high growth corridor with 6,600 at 63%. Then we go to regional New South Wales, and that includes places like Wiseman's Creek. That's all in postcode 2795 with more than 6,600. And that has the inevitable record of 100% recorded to be in mortgage stress. There are some local regional issues that are part of that, I think. And then we go to Queensland to 4305, which includes areas like Newtown, North Ipswich, Basins Pocket, with 70% in mortgage stress. Now let's move on to rental stress. And here, the postcode with the highest count of those in rental stress is actually Victorian, postcode 3000, that's the centre of Melbourne, with 12,800 households in rental stress, or 69%. Now, of course, the CBD in Melbourne, and indeed Sydney, has been hit with very low levels of activity since COVID. There are a lot of people living in and around the central area with very limited incomes and are having great difficulty paying their rentals on time. And quite a few of them have an overhang insofar that they had rental forgiveness programs for a period of time last year, but that doesn't necessarily mean that they still don't owe back rent. And then we go to postcode 2540, including areas like Sussex Inlet and St George's Basin, Sanctuary Point, down on the south coast of New South Wales, where there is 77% of households in rental stress at 10,080. Now here we are still dealing with issues relating to the bushfires from 2 or 3 years ago, to say nothing of the recent floods. Then we go to 2560, which includes Campbelltown and places like that, 10,050 in rental stress, or 81.5%. Then we go to Mount Druitt, Lethbridge Park, postcode 2770, where 9,433 are in rental stress, 77%. Then we go to North Ipswich and Basins Pocket, 4305, with a very significant number there. Then we go to the Central Coast, including Gosford, where 8,245 are in rental stress, or 70% of households. And it's worth noting here that we also have Surfers Paradise and Main Beach, also registering one of the issues we've seen as a considerable rise in rents in the beach areas of Queensland. And as a result of that, that's putting a lot of pressure on individual renters. More than 8,200 households are in difficulty. Then we come back to New South Wales, to places like Westmead and Wentworthville, with more than 8,000 in rental stress, or 62%. And then we go to the Queensland postcode 4655, which includes Happy Valley, Sunshine Acres, Torquay and Euroween, with 7,800 in rental stress. Over in WA, we then go to places in 6163, including Hilton, North Coogee, O'Connor, Sampson and Spearwood, 83.3% in rental stress. And we come back to Queensland postcode 4215, including Labrador and Southport, again close to the Gold Coast. 46% of households in difficulty, and that's more than 7,000 in rental stress. Now let's look at investor stress. And here, the postcode with the highest level of investor stress in February was postcode 2010. That includes the Surrey Hills and Darlinghurst, with more than 4,000 investors stressed, or 79% of those property investors. Now, when I talk about stressed investors, they've either got an issue with not enough income from the rents that they're receiving, if they can let the property at all, but I also include those who are trying to sell their investment property simply because the investment no longer works for them. The next on the list is Victorian postcode 3000, centre of Melbourne, with 3,900 stressed investors at 73%. Then we go to Main Beach and Surfers Paradise, with 56% of stressed investors there, or 3,926 in postcode 4217. And then we come back to the Rocks, the centre of Sydney, Sydney 2000, including Dawes Point and Haymarket, with 76% of stressed investors, or 3,700. Then we can go to Queensland to postcode 4670, which includes Bundaberg. And we can come back to New South Wales, to Sussex Inlet in the south coast, with more than 3,500 stressed investors. And some of that, again, is to do with the bushfires and the fact that the properties have yet to be rebuilt in those areas. Then we go to Maroubra and Pagewood, 2035. And then we go to St Kilda in Victoria, postcode 3182, with 3,200 stressed investors, or 65%. Then we go back up to Southport and Labrador in Queensland, with 47% of stressed investors, or 3,100. We come back to Randwick and Clovelly, which is 66% of stressed investors, or 3,000 having issues. We can go then to Queensland, postcode 4655 to Happy Valley, and there 36% of stressed investors are reported, with 2,973. And the last on the list here will be postcode 2099 at DY, Cromer, Narroween and Curl. That's of course a more affluent postcode up in the northern beaches, but again, some of those are having difficulty with regard to their property investments. 54% are actually registered as stressed. Now then, we'll finally look at financial stress, which is, as I've said before, an aggregate of the stress of the individual dimensions. And it's a weighted average across the various elements that we actually look at. So the postcode with the most financial stress this time was Toowoomba, postcode 4350, with 22,000 households in stress. That's about 48% of the postcode. Then we go to Campbelltown in New South Wales, 2560, with 81% of households in financial stress. Then we go to Liverpool and Liverpool South with 52.69%. That's postcode 2170. Then we go to Mount Druitt, Lethbridge Park, with 82.5% in financial stress, or 17,100. Melbourne, Victoria 3000, with 16,877 in financial stress. Then we go back up to Queensland, to North Ipswich and Basins Pocket. And that's postcode 4,305 with 16,453 households in financial stress. Then we go to Tamworth with postcode 2340 with 14,676. Down to Victorian postcode Narrow Warren and Narrow Warren South and Fountain Gate at postcode 3805. And Hoppers Crossing, postcode 3029 with 14,555. Craigieburn, Mickleham Rocks Park, then in Victoria 3064 at 14,554. Now those of course are all high growth areas. Then we go across to Samson, postcode 6163 with 14,000. Places like Tapping, Wanneroo and Janaruk in postcode 6065, 14,159. Then back to Ballarat, postcode 3350 with 14,123. Back up to Millbank and places around Windermere, Welcome Creek, and of course the whole Bundaberg area with 13,879. And finally we look at the Surfers Paradise Main Beach on postcode 4217 in Queensland with 13,855. So the point I want to make here is that there is a considerable range of different areas where financial stress is rife. And of course it includes those high growth corridors. That's where we've got considerable amounts of new development and homeland packages, a lot of recent first time buyers, a lot of first generation migrants, but we're also seeing some postcodes in other areas, including regional areas, where there are also difficulties. And let me just remind you that when I define stress, I define it in cash flow terms. That's money in and money out. I don't use a set percentage of income to define stress. Some people use a 30% measure, but frankly, that is just old hat and doesn't tell you much at all. So I look at real money in, real money out. Do they have enough money coming in to service all of their needs, particularly non-discretionary spending, plus their mortgage or rent or whatever it is? And if not, we put them in the stressed bucket. Now, of course, people who are stressed don't necessarily have an immediate issue because they can, for example, pull down on deposits or put more on credit cards. But if their cash flow maintains its negative stance for a period of time, that can create real issues down the track. And what I find quite often is that mortgage stress, therefore, or rental stress, is an early indicator of financial problems ahead unless people change their behaviour. Now, there are a few other factors to bear in mind here. The first is, of course, that the average mortgage size has grown considerably. In fact, the ABS data that came out recently showed that new mortgages are now somewhere between 15 and 20% higher than they were a year ago. And in fact, that trend has really accelerated in the last couple of years, which tells you something about the bank's ability to lend and willingness to lend at high income variables. And the other factor to bear in mind, of course, is that the markets are highlighting significant cash rate rises. This is the implied futures yield curve from the ASX as at the 11th of March 2022. And you can see here that they're looking at rates moving from 0.1%, which is the official cash rate currently, to more than 2.3% in August 2023. 2.310 in fact. Now it's worth highlighting the fact that these are market expectations, and to an extent the market is trying to second guess the Reserve Bank. The RBA has said quite consistently they don't expect rate rises anytime soon, and of course the RBA and APRA will be aware of the impact of rate rises, so the market is probably ahead of the RBA. On the other hand, if the Federal Reserve later this week lifts the cash rate in the US, as is quite likely, that's going to put more upward pressure on rates here. And my own perspective is that I think the reality of rate rises will be lower than the market is predicting, but is going to be higher than what the RBA is saying. But let me just tell you about the impact of this. This is actually based on the CBA mortgage calculator for a 30-year loan. And I've taken a $100,000 average loan, and I've put in a rate of 1.99%. That was pretty much the best rate you could get in the market. And the CBA calculator says that over the life of the loan, per $100,000, you'd pay $31,000 in interest, and that translates to a principal and interest repayment of $365 a month. Now, if rates were going up to 3%, so let's say 1% higher, then the total interest charge would go up to $51,778. But more importantly, your $100,000 loan would now have a monthly repayment of $422 per month, which is an increase of 15.6%. That's a considerable rise. And that is because rates being so low, an incremental rise has a significant impact on the interest rate and therefore on the repayment. And you can actually take the calculation either further. Again, using the same calculator at 4% mortgage rate, the total interest charge is $71,870 over the life of the loan. Your principal interest repayment would be $478 a month, which is up 31% from today. And that's for moving mortgages from 1.99% to 4%. And the point I want to make here is how sensitive households are to mortgage interest rate rises. We have very large loans, we're highly leveraged, and we also, of course, know that households have considerable pressures because of the cost of living rising very fast. That includes everything from fuel and food and other factors, for example, healthcare and childcare costs, to name but a few. Pretty much wherever you look, inflation is rampaging, and the general CPI of 2 to 3% is clearly understating the reality for most people. There are some examples that I've noticed in the shops where individual items have gone up 20 to 25% just this year so far. So the truth of the matter is that there is a real squeeze on, with household incomes still pretty flat, cost of living rising dramatically, and of course the risk of higher mortgage repayments ahead. Now, let me just then talk briefly about the RBA's growth expectations of wages. So this is essentially what the RBA is getting, and it's suggesting that households on one hand are saying almost no expectation of wages growth, well under inflation. The market economists and unions slightly more positive, but the story here is wages growth is not going to outstrip inflation growth, and that's a problem. And just to make that point, this is the inflation forecast from the RBA, the latest one they've published, before, of course, the Ukraine situation and before all the sanctions. And they're talking here about inflation rates going up towards 4% and then perhaps coming back later. I have a feeling that what we will see is inflation running even stronger than that and running higher for longer, which will put more upward pressure on interest rates from the Reserve Bank because, of course, that's the only lever that they've got. So what I've then done is I've taken all the information that I've got from my surveys and I've modelled the incremental impact of mortgage rate rises on mortgage stress based from February 2022. Remember, there's 1.5 million households. So if rates were to rise by 0.5%, I reckon another 142,000 households will fall into stress. If rates go another 0.5% higher to 1%, there'll be an additional 178,000. That's a cumulative total of nearly 350,000. If rates moved another 50 basis points higher, more than another 200,000 households will be pulled into stress, and we're knocking on towards the 500,000 households. If rates went to 2% higher, and I'm assuming this is all happening from today, then an additional 218,000 households would fall into stress. And so it goes on. And if you were to take a rate of 7%, which is sort of where perhaps the long-term rate average has been, that would put an additional 1.5 to 1.6 million households into mortgage stress relative to today. So these are incremental moves. What would happen if rates rose? More people would get into difficulty. Now, this is a very important conversation to have because, of course, what it means is that if we are in a higher interest rate environment, and those interest rates could be driven higher, firstly by the Reserve Bank lifting cash rates later in the year, or more likely by banks putting rates up because the cost of money internationally on the money markets is going up. And if, of course, the Fed lifts its rates this week, that is likely to happen. We're already seeing bond rates rising significantly and margins amongst the banks getting compressed. So the probability is that we are going to see higher mortgage rates ahead, and that's going to translate into more households getting into financial difficulty. And the trouble is that once you're in financial difficulty, it is very much harder to get back out of it again. Well, there are a few things you can do. The first is households tend quite often not to have a strong sense of what their cash flow is like. So the first thing to do is to create a cash flow. You can go to the ASIC Money Smart website and use some of the tools there to record essentially money coming in, money going out. And it's very important you do that after tax so you can get a real sense of the real money flows. Second, once you've done that, you can then look over your flows and prioritize those that are really important compared with those who are perhaps less important. For example, do you really need those 4 or 5 subscription services to the online streaming services? Or is your mobile phone plan really need to be that big? There are many things that you can do potentially to trim back expenditure now. The third, though, is if you are in financial difficulty, and particularly with your mortgage repayments, then it is important to go talk to the bank quickly and early. They do have an obligation to assist, and many banks will come up with ideas which may help. In some cases, things like, for example, extending the life of the mortgage, or moving to interest only, or indeed perhaps postponing payments for a period of time. Just be, of course, aware that all of this just continues to extend the debt for longer, so you will pay more interest ultimately. And if it's a short-term issue, for example, moving between jobs or illness, then maybe that's worth thinking about. But for many people, what we have now is structural stress, meaning it's not a particular situation that's short-term or will get fixed. It's a long-term drag on household incomes because the cost of living are rising so fast, incomes are not rising, the costs of the rent or the costs of the mortgage are rising, and that is going to continue. And the longer it continues, the more negative their cash flow will be and the more difficulty households will have in terms of dealing with it. And this is the early sign of issues which need to be tackled more structurally. And there are a couple of things. There are, of course, brokers and banks who will offer to refinance the mortgage, maybe to a cheaper rate, maybe not, and release equity. Now, releasing equity is not necessarily a smart move because it increases the amount of debt you have, although if it enables you to repay some of the debt and reduce your outgoings, it may be worth considering. But the truth is, you have to trim your expenditure to the shape of your income. And that means making some tough and hard decisions. We also know that some banks are now starting to put pressure on households in terms of saying their incomes have dramatically and permanently changed. As a result of that, they need to take more aggressive action. They would recommend, for example, selling the property and paying off the bank from the proceeds. Now that, of course, may be worthwhile thinking about, but of course it leaves you with a big question as to where to live subsequent. There are no easy answers here, but ultimately we have to talk about behavioural norms. And in fact, Steve Mickenbecker from Canstar and I did a show on this the other day when we spoke about the norms that exist at the moment, which are very much debt-driven. Sometimes more debt is not the answer. So it is important to go through this process now and prepare for the higher rates that are coming, because all of the indicators that I'm seeing in my surveys and in the broad economic data is that mortgage stress is going to go higher, and it's going to go quite a lot higher, and it's going to go there quite quickly. And that's going to put more households under pressure, which means that households will spend less, which means that the economic consequences will be quite significant, and that could stymie growth. There's another factor here to bear in mind, and that is that the very strong property price inflation was driven by very weak controls on lending. As a result of that, people have been able to leverage up 8 to 10 times their income, which is dramatically high. So we need to see a change in the weather in terms of bank lending. We need to see a change in the weather in terms of regulatory intervention to pull back some of the excesses, and banks need to take more accountability and responsibility to make sure that the loans they're making are sustainable and suitable for the customers that they're actually offering the loans to. Unfortunately, many people will take the bank's word for it, saying, well, if the bank says it's okay, it must be okay. But unfortunately, the bank is looking at it from a risk perspective, not the same as your perspective. They'll have made some assumptions about how much you can afford not to spend or to spend. And some of those are very, very aggressive assumptions, meaning most households end up spending more than those assumed in the models that the banks use when they're making a loan assessment. So this is getting very tricky now, and my own view is we're going to see considerably more mortgage stress ahead as prices continue to rise. Inflation will stay high for quite a lot longer than people were expecting, particularly because of what's happening in Ukraine. And the bottom line is this: if you have financial pressure at the moment, start tackling it, start adjusting, start making changes, because ahead the financial pressures are going to get even worse. Now, just before I go, I want to highlight that you can get very granular information about our mortgage stress down to a postcode level, and indeed get a sense of some of our thinking with regard to where prices might move from here. It's available in the DFA portal. That information is updated monthly, and it is accessible via a Patreon subscription. It's $50 US a month, and if you sign up to that, then you can get a lot more information than I've been able to share today. And just to give you a bit of a flavour, let me just put in a particular postcode. So this is an example of the information we get from the model, which gives you the total situation. This is New South Wales postcode 2000, and there are 13,800 households in the postcode, of which 1,700 are borrowing, 11,000 are renting, 8,000 properties for rent, and there are around 6,500 rental property owners in the area, and the overall financial stress metric is 78%. Now that comprises of stress for mortgages, which is sitting at 27%. 460 households have mild mortgage stress. There are none with severe. Risk of default is 2% or 32. But rental stress is 59%, which is 6,520 households. And investor stress is 76%, which comprises 3,739, of which 1,234 are severely stressed. The other thing this gives you, it gives you a bit of a flavour of what we are modelling with regard to price changes. This is for houses, which shows that in our best case, we think there will be a small fall over the next couple of years, but then a rise, but not a very big one. So over 3 years, the bullish case is up by 0.6% over 3 years for houses. The medium case, the neutral case, is with a fall of 8%, and the bearish case is a fall of 17%. And for units, we see an overall bullish case of just 0.5% over 3 years, with a fall over the next 12 months of about 2.7%. That's the bullish case. The mid case is down 6% over 3 years, and the bearish case is down 12.9% over 3 years, with a more considerable drop over the next 12 months. Now, I should just highlight the fact that this is not a prediction. It's simply a modelling of the current information that we have. It will change again, but it gives you a trajectory flavour as to where prices may or may not go. Now, let me just compare that with Southport and the surrounding areas, including Labrador. And those, of course, figured quite strongly in the information that we discussed a little while ago. And there were around 24,900 households, of which 5,400 are borrowing, 16,500 are renting, and about 12,300 properties are for rent. And the total financial stress metric is 48%. There are 1,185 households in mortgage stress, which is 22% of households. Overall default rates are at 3%, 148. Rental stress is sitting at 47%, 7,736. And investor stress is 47%, with 3,106 stressed investors, of which those severely stressed are 467. Now, again, looking at the trajectory of price changes based on the data we've got, we're suggesting that in a bullish case, we could see a rise of 3.5% over the next 12 months and a continued rise up to 5.4% over 3 years. That's the best case. The neutral case is a fall down 3.6% over the next 12 months for houses. The bearish case is down 12.7%. For units, we see a rise of 4.1% over the next 3 years. That's the most bullish case. The neutral case is down 2.6%, and the bearish case is down 9.3%. Now, let me just make the point that I hope to run a live show probably early next month, where you'll be able to ask me live about specific postcodes. But if you would like more information about what's going on with regard to the model, you can reach for me via the DFA blog, or indeed sign up directly via Patreon. The links are below. And just to remind you, the Patreon is the $50 a month level. You can subscribe for as long as you want, and you'll get information on more than 2,000 postcodes across the country that we update each month. This is probably one of the most important and, of course, interactive tools that we've got, insofar that it helps you to plan out what may happen with regard to future price movements. And in fact, there are various tools that allow you to, for example, compare different postcodes or look at different projections. So it's a pretty useful set of tools, and I expect to be adding more tools in the weeks and months ahead. So do go sign up via Patreon to get access to this tool. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.